You think you understand value investing, but when the world is burning and stocks are dropping like stones, you freeze. That's the difference between those who build dynasties and those who watch from the sidelines. In the next few minutes, I'm going to walk you through these 4 battle-tested fortress stocks that have survived every crash I've witnessed in my 99 years. And if you stay with me until the end, you'll discover exactly how to position yourself to profit massively when fear reaches its peak and everyone else is running for the exits. So, before we dive in, do me a favor, hit that like button, subscribe if you haven't already, and tell me in the comments where you're watching from, because I want to know where my fellow rational investors are who understand that the greatest fortunes are built when the blood is running in the streets. Here's what nobody tells you about getting rich during a recession. Listen to me carefully. I've lived through 15 recessions. I've watched the Great Depression destroy my neighbors. I've seen the dot-com bubble burst. I witnessed the 2008 financial crisis obliterate portfolios that took decades to build. And I'm going to tell you something that will shock you. Every single one of those disasters made me wealthier. Not because I'm smarter than you, not because I had inside information, but because I understood one fundamental truth that 99% of investors completely miss. Recessions don't destroy wealth, they transfer it. They take money from the panicked and hand it to the patient. They take assets from the fearful and deliver them to the rational. And right now, as I look at the economic landscape in 2023, I see the same patterns, the same euphoria, the same dangerous confidence that precedes every major correction. You want to know what keeps me up at night? It's not the thought of losing money in a crash. At my age, I've got more money than I could spend in 3 lifetimes. What bothers me is watching people, good, hardworking people, make the same catastrophic mistakes I've seen repeated over and over for nearly a century. They're buying stocks at all-time highs. They're convinced that this time is different. They're ignoring every warning sign because the market has been going up for so long that they've forgotten what gravity feels like. Let me paint you a picture of what's actually happening right now in our economy. Corporate debt is at levels I've never seen before. Companies are borrowing money at rates that make no sense just to buy back their own stock and artificially inflate their share prices. The average person is drowning in consumer debt, financing lifestyles they can't afford with credit cards, charging interest rates that would make a loan shark blush. And everyone, from your barber to your accountant, thinks they're a genius investor because everything they've touched has gone up. This is not normal. This is not sustainable. This is the setup for a transfer of wealth so massive that it will define the next generation of millionaires and billionaires. But here's the critical part you need to understand. You cannot wait until the crash happens to prepare. By then, it's too late. The life rafts are already full. The best assets are already being quietly accumulated by people who saw this coming and positioned themselves accordingly. I'm 99 years old, and I've spent the last 60 years as Warren Buffett's partner at Berkshire Hathaway. I've helped build one of the most successful investment companies in human history, and I'm telling you with absolute certainty that we are approaching a moment of reckoning. The question isn't whether a significant correction is coming. The question is, will you be ready to profit from it? Here's what most people don't understand about bear markets and recessions. They think the goal is to avoid losses. Wrong. The goal is to have capital available when assets go on sale. You see, in 2008, when Lehman Brothers collapsed and the world thought the financial system was ending, Berkshire Hathaway wrote a check for $5 billion to Goldman Sachs. Everyone thought we were crazy. The talking heads on television said we were catching a falling knife. But we weren't gambling, we were shopping. We negotiated terms so favorable that we made billions in profit while the fearful were selling at the bottom. That's the power of having cash when everyone else needs it. That's the advantage of thinking rationally when everyone else is panicking. And that opportunity is coming again, sooner than most people think. The 4 fortress stocks that will survive anything the economy throws at them. Now let me tell you about the 4 types of businesses I would buy and have bought during every major market crash I've experienced. These aren't hot tech stocks. They're not cryptocurrency. They're not whatever trendy nonsense is being promoted on social media. These are businesses with economic moats so wide that they could survive a nuclear winter. First, let's talk about consumer staples. but not just any consumer staple company. I'm talking about businesses that sell products people literally cannot stop buying no matter how bad the economy gets. Think about Costco. I've been a Costco member since the early days, and I've watched that company execute flawlessly through multiple recessions. Why? Because when times get tough, people don't stop buying food, toilet paper, and basic necessities. They actually become more price conscious and flock to value retailers like Costco. The business model is brilliant. They charge you a membership fee just for the privilege of shopping there, which creates a psychological commitment that keeps you coming back. They operate on razor-thin margins, which makes it almost impossible for competitors to undercut them. And they treat their employees so well that turnover is incredibly low, which reduces costs and maintains quality. During a 50% market crash, Costco stock will probably fall too, maybe 20%, maybe 30%. But the business itself, it will keep humming along. People will keep renewing their memberships. They'll keep buying rotisserie chickens and bulk toilet paper. And when you can buy a piece of that machine at a 30% discount, that's not a crisis, that's a gift. Here's what I want you to understand about this type of investment. You're not trying to time the bottom perfectly. You're not trying to buy at the absolute lowest price. You're trying to buy wonderful businesses at fair prices, or better yet, at unfair prices that favor you. When fear is at its peak and everyone is selling, that's when businesses like Costco become available at prices that make no rational sense. And that's when you back up the truck and buy. The second type of business I focus on is what I call regulated monopolies. Utilities and infrastructure companies that provide essential services with limited competition. Think about the company that provides electricity to your home. Can you choose not to pay your electric bill during a recession? Of course not. You need power for heating, cooling, refrigeration, and just basic modern life. These companies operate in markets where competition is severely limited by regulation and the massive capital requirements needed to build infrastructure. They're boring. They don't double in a year. But they also don't collapse when the economy tanks. During the 2008 crisis, while banks were failing and tech stocks were getting obliterated, utility companies just kept collecting their monthly bills and paying their dividends. Some of them barely dropped at all. The ones that did drop gave you the opportunity to lock in dividend yields of 6%, 7%, sometimes 8%. Guaranteed income backed by essential services that people cannot live without. Here's a specific example. I've always admired companies like Dominion Energy or Duke Energy. They're not exciting. They're not going to make you rich overnight, but they own the physical infrastructure, the power plants, the transmission lines, the distribution networks that would cost billions to replicate. That's a moat. That's protection. That's the kind of business that allows you to sleep at night when the market is crashing because you know that regardless of what happens to the stock price, the underlying business is still generating cash and paying you dividends. When you can buy these businesses at a 30% or 40% discount during a panic, you're essentially locking in higher dividend yields and setting yourself up for years of reliable income. This is how you build wealth that lasts through multiple market cycles. The third category might surprise you: high-quality financial institutions with fortress balance sheets. Now, I know what you're thinking. Didn't banks nearly destroy the world in 2008? Yes, the reckless ones did. The ones that were over-leveraged, making stupid loans and taking excessive risks absolutely deserve to fail. But not all banks are created equal. There are financial institutions that have maintained conservative lending standards, strong capital ratios, and diversified revenue streams for decades. These are the banks that actually become more valuable during a recession because they have the capital to lend when everyone else is too scared, and they can acquire weaker competitors at fire sale prices. Look at what J.P. Morgan did during 2008. They bought Bear Stearns and Washington Mutual for pennies on the dollar, instantly expanding their market share and acquiring valuable assets at a fraction of their worth. Jamie Dimon positioned that bank to not just survive the crisis, but to dominate coming out of it. When I think about buying a bank during a 50% market crash, I'm looking for specific things: a conservative loan-to-deposit ratio, strong capital reserves, well above regulatory requirements, diversified revenue streams beyond just lending, and a management team with a track record of navigating previous downturns. Banks like this don't just survive recessions. They thrive during the recovery because they have the capital to lend to businesses and individuals when credit is scarce. They become the essential bridge between where the economy is and where it's going. And if you can buy them when everyone else is terrified of the entire financial sector, you're setting yourself up for spectacular returns. I've made some of my best investments in financial institutions during periods of maximum pessimism, and I've never regretted a single one. The fourth and final category is what I call vice and necessity businesses. Companies that sell products people consume regardless of economic conditions, sometimes even more during tough times. I'm talking about companies like Coca-Cola, which I've praised for decades. You think people stop drinking Coke during a recession? Actually, they might drink more because it's an affordable pleasure during stressful times. Or think about companies like Philip Morris International. Now, I'm not encouraging anyone to smoke, but from an investment standpoint, tobacco companies have some of the strongest pricing power and most reliable cash flows in the entire market. Why? Because nicotine is addictive, and people don't quit smoking just because the economy is bad. In fact, during recessions, some people smoke more to deal with stress. These businesses generate enormous amounts of cash that they return to shareholders through dividends and buybacks. When you can buy Coca-Cola at a 40% discount during a market panic, you're buying a global distribution system, one of the world's most valuable brands, and a management team that has navigated over a century of economic cycles. The stock price might fluctuate wildly, but the business keeps selling sugary drinks to billions of people around the world, and those sales generate cash that gets paid out to you as a shareholder. This is the beauty of focusing on businesses rather than stocks. The stock is just a piece of paper that fluctuates based on emotion. The business is a machine that produces value regardless of what the stock market thinks on any given day. How to actually execute this strategy when fear is at its peak and everyone thinks you're crazy, here's where the rubber meets the road. You can know everything I just told you. You can understand intellectually why these businesses are valuable. You can create a perfect watch list of companies you want to buy. But if you don't have the psychological fortitude and the financial preparation to actually execute when the time comes, all of that knowledge is worthless. Let me tell you what it actually feels like to buy stocks during a 50% crash, because I've done it multiple times and it never gets easier. The news media is screaming that the world is ending. Your neighbors are talking about how they lost half their retirement savings. Your spouse is looking at you like you've lost your mind for even thinking about putting more money into the market. Every headline is predicting that stocks will fall further. Every expert on television is explaining why this time is different, why the recovery will take years, why you should wait for things to stabilize before investing. And that's exactly when you have to buy. That's exactly when the greatest opportunities present themselves. But you can only do this if you've prepared in advance, both financially and psychologically. Financially, this means you need to have built what I call an opportunity fund, cash that's sitting on the sidelines, specifically waiting for a major market dislocation. This is separate from your emergency fund. This is money that you've earmarked for investing but are holding in cash or very short-term treasury bills until the right moment arrives. How much should be in this fund? That depends on your overall wealth and how aggressive you want to be, but I'd suggest at least 20% to 30% of your total investment capital should be in dry powder when valuations are stretched and markets are at all-time highs. Now, some people are going to object, but Charlie, I'm losing money to inflation by holding cash. Listen to me very carefully. If you're holding cash waiting for a 50% crash and that crash happens, your cash has just increased its purchasing power by 100% relative to stocks. You can now buy twice as many shares of wonderful businesses as you could before. That's not losing to inflation. That's winning the patient investors game, the people who are 100% invested at market peaks because they're afraid of missing out or losing to inflation, are the ones who actually lose when the crash comes. They watch their portfolios get cut in half, they panic and sell at the bottom, and they miss the recovery because they're too traumatized to get back in. Don't be that person. Psychologically, you need to train yourself to think differently than the crowd. This is harder than it sounds. We're social creatures. We're wired to follow the herd because for most of human history, being separated from the group meant death. But in investing, following the herd leads you off a cliff. You need to develop what I call rational contrarianism, the ability to go against popular opinion, not because you're trying to be different, but because you've done the analysis and you understand that the crowd is wrong. Let me give you a specific example from my own experience. In 1974, during one of the worst recessions in modern history, stocks were getting destroyed. The Dow Jones had fallen nearly 50% from its peak. Everyone was convinced the market would go lower. Oil prices had quadrupled due to the OPEC embargo. Inflation was rampant. Unemployment was rising. It was genuinely scary. Warren Buffett wrote an article that year titled How Inflation Swindles the Equity Investor, and at the end, he mentioned almost casually that he was finding opportunities he hadn't seen in years. People thought he was crazy. But what was actually happening? Wonderful businesses were being sold at prices that made no sense. The Washington Post Company, which owned not just the newspaper but also valuable television stations, was trading at a market value less than the liquidation value of its assets. In other words, you could buy the entire company for less than you could sell its pieces for. That's insane. That's the kind of opportunity that only presents itself when fear overwhelms reason. Here's your action plan for when the crash comes, and trust me, it will come. First, you ignore the news. I'm serious. Turn off CNBC. Stop reading the financial headlines. They're designed to generate emotion, not inform decisions. The news media makes money from your attention, and fear is the most attention-grabbing emotion there is. They will bombard you with reasons why you shouldn't invest, why this crash is different, why you should wait. Ignore all of it. Second, you pull out your pre-prepared watch list of the wonderful businesses we discussed, the Costcos, the utilities, the fortress banks, the Coca-Colas of the world. You've already done your research on these companies during calm times. You know their business models. You know their competitive advantages. You know what they're worth. Now you just need to check, are they trading at prices that give you a significant margin of safety? Here's a simple rule I use. If a wonderful business that I would normally be happy to buy at 15 times earnings is now available at 8 or 9 times earnings because of a market panic, I buy. I don't try to predict if it will fall further. I don't wait for the bottom because nobody can identify the bottom until after it's passed. I simply ask, is this a good business at a good price? If yes, I buy. If it falls further, I buy more. This is called scaling in, and it protects you from the psychological damage of buying too early and watching your investment immediately drop 20%. Instead, you're building a position over time, averaging down as prices fall, and accumulating shares at increasingly attractive valuations. Third, and this is crucial, you must keep working, keep earning, and keep having cash flow coming in. The biggest mistake I see people make is going all in at what they think is the bottom, exhausting all their resources, and then having nothing left if prices fall further or if personal emergencies arise. You need to maintain your earning power. You need to protect your primary income sources. You need to live below your means so that you're generating excess cash that can be deployed over time. This isn't a one-day event. A real market crash and the subsequent recovery can take months or even years to play out. You need staying power. You need endurance. You need the financial and psychological ability to keep buying when it feels the most uncomfortable. Let me share something personal with you. In 2008 and 2009, when the world felt like it was ending, I wasn't excited. I wasn't happy. I was actually quite somber because I could see the real suffering that was happening. People losing their jobs, their homes, their savings. But I also knew with absolute certainty that this was going to pass. Recessions always pass. Markets always recover. And the businesses that survive and thrive through the difficult times emerge stronger and more valuable than before. So we kept buying. We bought when it was scary. We bought when it was uncomfortable. We bought when our friends thought we were crazy. And we made an absolute fortune because we had the courage to be rational when everyone else was being emotional. Now, I need to be very clear about something. I'm not telling you to gamble. I'm not telling you to buy speculative nonsense or companies with questionable business models just because they're down 80%. Most of the companies that fall 80% in a crash deserve to fall that much because they were overvalued garbage to begin with, and many of them will never recover. What I'm telling you is to buy wonderful businesses at wonderful prices. There's a huge difference. A wonderful business has a sustainable competitive advantage, generates strong free cash flow, has competent and honest management, and serves a real need that won't disappear during a recession. When you can buy these businesses at a 40%, 50%, or 60% discount to their intrinsic value, that's not speculation. That's intelligent investing. Here's my final warning, and this is the most important thing I'll tell you. The time to prepare for a recession is not during the recession. It's right now, before the crisis hits. You need to be building your opportunity fund now. You need to be studying businesses and creating your watch list now. You need to be reducing unnecessary expenses and increasing your savings rate now. You need to be developing the psychological framework and the rational contrarianism now, because when the crash comes, and it will come, everything happens fast. The best opportunities appear and disappear in weeks or months, not years. If you're scrambling to figure out what to do, if you're paralyzed by fear, if you don't have capital available, you will miss it. And you'll watch from the sidelines as the prepared investors of the world acquire assets at generational discounts. I'm 99 years old. I've seen it all. I've made mistakes, and I've had tremendous successes. But the pattern I've observed is absolutely clear. Wealth flows from the panic to the patient, from the emotional to the rational, from the unprepared to the prepared. In the coming recession, there will be a massive transfer of wealth. The only question is, which side of that transfer will you be on? Will you be the person selling wonderful businesses in panic at 50 cents on the dollar? Or will you be the person calmly buying those businesses and holding them for the next 10, 20, 30 years while they compound and make you wealthy? The four fortress stocks I've described, consumer staples like Costco, regulated utilities, fortress financial institutions, and vice and necessity businesses. These aren't secrets. They're hiding in plain sight. Everyone knows these businesses exist. But most people lack the discipline to hold cash when markets are high, the courage to buy when markets crash, and the patience to hold through the recovery. That discipline, courage, and patience is what separates the wealthy from everyone else. It's not intelligence, it's not luck, it's behavior. And your behavior is entirely within your control. So here's what I need you to do right now. First, hit that like button, not for my ego, but because this information needs to reach people who are sleepwalking toward financial disaster. Second, subscribe to this channel and turn on notifications because the specific companies, the detailed analysis, and the real-time updates during the next crisis will only be shared here. Third, and most importantly, take action today. Open a spreadsheet. List your expenses. Identify what you can cut. Start building your opportunity fund. Create your watch list of wonderful businesses. Do the work now while things are calm so that when the storm hits, you're ready. Your financial future isn't determined by what happens to you. It's determined by how you prepare for and respond to what happens. The recession is coming. Make sure you're ready to profit from it. Now get to work.